this again. Oh, brother. I hate this fucking thing. I hate YouTube. I kind of really do. Because every time you restart a stream, it starts a whole new thing, and it's just dumb. There we go. It gives you a whole new hyperlink, and it's I don't know why. I don't know. It's just dumb. Dumb, 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 dumb. And then you got to go in and clear all this shit out and redo the hyperlinks and blah blah blah. And it's just dumb. I don't know why it makes you go through all that, but just give me a minute to get this started back up again. Hopefully nobody clicked in here. Make sure this is working. Chat's probably gonna have to be. There we go. Okay. All right, we're getting there. Of course, I shared the link with a bunch of people, so now I need to reshare it so the right link goes through. That's what I hate about YouTube. You got to start and stop your stream. All right. So let's try this over again. Okay, we got that. We got that. We're good, good, good. We'll start in 30 seconds. Make sure that's right. Okay. That should be right. Okay, cool beans. All right, let's start all over again. I did share it on Facebook, so if you wanna practice with me, you can put what you think the answer is into chat, like A, B, C, or D. That's kind of what I'm doing here. Okay. So question one, this is again in regards to contracts, clauses, amendments, and addenda. Question one, Jerry and Simon signed a contract so that Jerry could purchase all of Simon's restaurant equipment for one price after Simon closes his restaurant next month. The contract contains a provision that states Jerry has 1 year from the purchase date to file a suit relative to the purchase. After the year is up, Jerry forfeits the right. What kind of contract clause is this? Is this A, specific time, B, statute of limitations, C, time is of the essence, or D, time of performance? All right, start the timer now. 30 seconds. Answer A, B, C, or D in chat. All right. The answer, I believe, is B, statute of limitations. Let's check the answers. Statutes of limitations is the only one that's a traditional contract clause. It is basically it basically gives a date by which all performance must be completed, where the party forfeits any legal rights. All right, question two. Whoa, I'm gonna do that. There we go. you didn't move it over if you meant to. Oh, okay. You'll need your headset because obviously we don't want repeats of sound. Let me know if you can't hear it. Question 2. I'll give you a minute because you're the only one watching anyway.
Go ahead.
Question 2.
I can't hear you.
It's going to be a slight delay. You hear me now? Okay. Question 2. Camille, a buyer, wants to change the price already agreed to in a sales contract. She should use A or an blank. A new contract, A, new contract, B, amendment, C, addendum, or D, bill of sale. So I'll ask it again. Camille, a buyer, wants to change the price already agreed to in a sales contract. She should use a blank new contract, B, amendment, C, addendum, or D, bill of sale. Put A, B, C, or D in chat. All right, so we have one answer of B, amendment. Let's see if that answer is correct. Yes, it is. An amendment changes existing contract terms. Once signed by both parties, it becomes part of the contract with the same legal weight as the original contract. The remaining terms in the original contract remain the same. Okay, one moment. All right, good deal. All right, let's make sure you can hear me too.
I just heard it.
Okay. All right, next question. We're going into contracts, offers, purchase, and agreements. All right. Question one. Kendra made an offer on Sam's property. Sam rejected Kendra's offer, but made a counteroffer. Kendra is now considering the counter. What is what is Kendra in this scenario? So Kendra made an offer on Sam's property. Sam rejected Kendra's offer, but made a counteroffer. Kendra is now considering the counter. What is Kendra in this scenario? A. Executor. B. Offeror. C. Offeree. Or D. Trustor. 30 seconds to put A, B, C, or D in chat. Okay, looks like we've got one answer. C. Offeree. 2 seconds. C. Offeree is correct. Good job. The correct answer deals with offers, so Kendra is either offeror or the offeree. The person considering the offer is the offeree. So that's Kendra's role now that Sam made a counteroffer. Question 2. Tristan's offer has been signed by all parties and delivered back to the seller. This means that blank has occurred. Again, Kristen's offer has been signed by all parties and delivered back to the seller. This means that blank has occurred. A. Acceptance. B. Binding acceptance. C. Personal delivery. Or D. Notarization. A, B, C, or D in chat. 30 seconds. Paul is saying A. Acceptance. Let's go ahead with A. Acceptance. I don't see anybody else in chat. And that is incorrect. Let's try again.
Binding.
So now we're going to say B. Binding. And the answer is yes. Binding acceptance happens when a signed contract is delivered according to delivery procedures and deadline outlined in the contract. Next question.
But it didn't say the seller signed it. So why? So I don't know if it's binding.
Caitlin really wants to include an inspection contingency in her purchase offer. Her agent explains that the inspection contingency only documents which of the following: A. How much money the sellers will spend on fixing inspection issues. B. The inspector who Caitlin will use. C. Whether Caitlin will ignore some of the inspection issues. Or D. The date by which all inspection issues will be addressed. Go ahead and give us 30 seconds to take a look at that. Put our answer in. All right, looks like we've got D. Let's try that. That is correct. An inspection contingency is a way of signaling to the seller that if the inspector finds property condition issues, the buyer may require the sellers to fix those issues or may even terminate the contract. The one thing that the inspection contingency must do is document the date prior to closing by which all inspection issues must be fixed. All right, next question. Question 4. Gail was supposed to close on her new home by the end of May, but she kept asking the sellers if they could push the closing back. Even after the summer was over, the transaction still had not closed. Gail was guilty of not adhering to which aspect of the contract? Was it A, assignment, B, novation, C, reasonable time, or D, time is of the essence? D, time of the essence is correct. Reasonable time is what parties are supposed to adhere to if a date hasn't been specified in the contract. All right, we're going to go to, what's our next one here? Counter offers, multiple offers. Under contracts. What happens to an initial offer when the buyer, from the buyer after a seller counters? So again, what happens to an initial offer from the buyer after a seller counters? A, it becomes the backup offer. B, it's no longer in play. C, it's accepted by the seller until the buyer accepts the counter. Or D, sellers cannot counter a buyer's initial offer. All right, Paul says it's no longer in play. That's correct. If a seller, or buyer for that matter, wants to counter an offer, it should be relayed to, to a significant term because it essentially takes the original offer out of play. Should be related to a significant term, yeah. A counter offer is not a seller's way of saying, I will accept your offer if you don't accept my counter. A counter cancels the original offer. All right. Which offer would be the most appealing to a seller? A, an all-cash offer, 15,000 over list price, closing in 2 weeks. B, an offer of 10,000 over list price, contingent upon appraisal and inspection, conventional financing with 20% down, closing in 30 days. C, a full price offer, waiving inspection, conventional financing with 20% down, closing in 45 days. Or D, it depends on the needs and motivations of the seller. Go ahead and place A, B, C, or D in chat. And we're going with D, which is correct. The first principle evaluating multiple offers is this: the appeal of any offer comes down to the seller's needs and motivations. All right, I'm going to go to continue to financing. Questions on financing? Oh, we did do. Are we in financing? Okay, yeah, we're doing the study portion of financing. Fine. We're skipping the little exams, but that's fine. Leonard is offered a loan of 5.75%. Because he plans to be in his home for several years, he chooses to pay points up front to have the rate reduced to 5.25%. What's this an example of? A, down payment, B, usury, C, buy down, or D, gap financing? Okay, we're saying C, buy down, and that is right. When buyers voluntarily pay to bring interest rates down, this is called a buy down. Good deal. All right. Question 2. Jeffrey has accepted an offer of $299,000 for his house. The buyer is making a $50,000 down payment, and the buyer's appraisal came in at $300,000. At what number will the buyer's lender base the loan to value ratio? So Jeffrey has accepted an offer for $299,000 for his house. The buyer is making a $50,000 down payment, and the buyer's appraisal came in at 230,000. What number will the lender base the loan to value ratio? Will it be 300,000, 299,000, 310,000, or there's no way to tell given the data provided? Looks like we have B, 299. Lenders use the lesser of the sales price or appraisal value. That is correct. The Bransons have a conventional loan for which they were required to obtain private mortgage insurance. Their local real estate market has been on fire lately, and their house is now appraised twice their loan balance. Will their PMI be automatically canceled? A, yes, because their equity is over 20%. B, no, because PMI lasts for the life of the loan. C, yes, because their equity position is at least 50%. Or D, maybe, but they'll have to petition their lender. A, B, C, or D? What do you think, Paul? I know my answer. D. That would be my answer as well. They might be able to get rid of it, but they would have to petition their lender when the loan to value ratio is 80% or less. PMI is automatically canceled. Borrowers may have to petition for PMI to be canceled and must be current on payments. Okay. Which of the following best describes annual percentage rate, APR? A, the amount a borrower pays in interest for a single year. B, fees charged by a lender expressed as a percentage. C, the amount a lender can collect in interest from a borrower during a single year. Or D, a standardized measure for interest rates and other loan costs. This is a tricky one. I know the one it feels like it should be. D, a standardized measure for interest rates and other loan costs. Yes, Regulation Z requires lenders to use a standardized measure for loan costs, including interest rates, which is the APR. Sam's not very good with planning for his expenses. He has a mortgage payment that includes his property taxes and property insurance, PITI or PITI. So he can knock those all out with his mortgage payment each month. Sam's also happy to know that his monthly payment will remain the same for the life of his loan. What type of mortgage does Sam have? Does he have an A, straight mortgage, B, budget, C, amortized, or D, adjustable? You saying B, budget? You're right. Budget mortgages are a type of amortized loan that include principal, interest, taxes, and insurance (PITI) in each amortized monthly payment. Sandra, a buyer, signs all the required mortgage documentation and promises to make all payments to her lender. Unfortunately, Sandra falls on hard times and misses multiple payments, and the bank indicates that it is going to foreclose on her. The foreclosure proceedings are more difficult for the lender because Sandra holds the title to the land. What kind of state does Sandra live in? A lien theory state. B, a deed of trust theory state. C, a title theory state. Or D, an intermediary theory state. So that is incorrect. The other possible answer, I believe, would be A, In a lien theory state, the mortgage becomes a lien on the property, but title remains with the buyer. Foreclosure proceedings in a lien theory state may be more difficult for the lender due to the fact that the buyer is holding title to the land and not the lender. Financing types of loans.
I always get that one right.
Yeah, those two are a little confusing at times. Which of the following statements is true about conventional loans? A. Originators usually package and sell the loans on the secondary market. B. They're guaranteed by the U.S. Department of VA, Veterans Affairs. C. They're insured by the Federal Housing Administration. D. They're provided by the U.S. Department of Agriculture. This one's a little easier, isn't it? Conventional loans are not part of the VA. They're not part of the Department of Agriculture. Are they insured by the FHA? No. They would be originators usually package and sell the loans on the secondary market. There you go. Which of the following is a true statement about FHA financing? A. An FHA loan is usually more attractive to buyers who have lower credit scores and down payments. Lower credit scores and lower down payments. B. FHA loans are available to all borrowers regardless of credit history. C. FHA loans are best for borrowers who have large down payments. Or D. FHA loans have more stringent requirements than conventional loans do. A. An FHA loan is usually more attractive to buyers who have lower credit scores and less money to put down. Question 3. Sandra retires from a career in the Navy and is ready to buy her first home, a small bungalow in a quiet neighborhood for $169,900. Her military service qualifies her for a VA guaranteed loan. What's her required down payment? A 0%, B 3.5%, C 15%, or D 20%? The VA loan was part of the GI Bill of 1944 and it offers financing with no down payment. All right, next question. Chris owns Country Time Ranch and wants to expand his sheep and lamb farm by branching into milk production and cheese making. He wants to purchase the property adjacent to his farm, which would give him an extra 10 acres of farmland. Chris's ranch will provide a significant boost to the local economy. Assuming his income meets the program's criteria, what type of loan may Chris find the most desirable? A. A VA guaranteed loan. B. A wraparound mortgage. C. A rural development loan. Or D. A growing equity mortgage. Rural development loans, also known as USD loans, are government loans specifically offered to family farms and to help finance housing in rural areas through the Farm Service Agency, an agency of the USDA. Paul, you're just gonna fly right through the state test. In 8 years, Margot will inherit a sizable chunk of money from her grandmother. Margot wishes to purchase a home now and qualifies for a 10-year loan with regular affordable monthly payments. At the end of the loan's term, she'll owe the entire principal balance at once, which she's prepared to pay with some of Grandma's money. What kind of loan will Margot be using? A bridge loan, B, a balloon loan, C, a graduated payment loan, or D, a budget loan? A balloon loan allows borrowers to make regular amortized payments, then make a balloon or lump sum payment at the maturity date. A lender can amortize the loan over a 30-year period with a balloon payment at the end of 10 years. Janice is extremely excited to have purchased her first home. She was able to lock in her monthly payment at a very low rate for the first 5 years. In year 6, Janice's payments will become significantly higher based on the going market rates. What type of loan does Janet have? A. A purchase money mortgage. B. An adjustable rate mortgage. C. A wraparound mortgage. Or D. A straight term loan. Janice has a 5-1 adjustable rate ARM, where the payment and interest rate are locked for the first 5 years. The interest rate is adjusted based on the behavior of the economic index it's associated with and changes each year. Monica receives a promotion at work that requires her to relocate. Because of the timing of her promotion, she'll need to buy a new house in her new city before her current one is sold. So she won't have any equity from her current home to make a down payment on the new house. What loan option would allow her to make the purchase before selling the old house? A. A fixed rate loan. B. Bridge loan. C. Amortized loan. Or D. Wraparound mortgage. B. Bridge loan. Sometimes there is a delay between the sale of a property and the purchase of another, and the bridge loan allows the homeowner the ability to pay for 2 homes at the same time. Charles is selling his property to Seth. Charles paid off his own mortgage on the property years ago, so he's in a position to provide 100% financing of Seth's purchase price. All right, let me restart that one. Charles is selling his property to Seth. Charles paid off his own mortgage on the property years ago, so he's in a position to provide 100% financing of Seth's purchase. Seth will make payments to Charles while Charles retains the property title. What is this an example of? A. Purchase money mortgage. B. Wraparound mortgage. C. Land contract. Or D. A straight term loan. C. Land contract. That's what it's right to me. All right, let's go to financing and lending. I'm going to finish out this subtopic. This is probably what I should be doing, although this would make it much harder for me, but let's do that. If Acme Bank, a primary lender, wants to sell its loans on the secondary market, it would be easier for it to do so if its loans met A. FDIC guidelines, B. Fannie Mae and Freddie Mac guidelines, C. FHA guidelines, or D. VA guidelines. I'm kind of between two. I don't know for sure. So we'll see what Paul thinks here. Paul's going to say B. Fannie Mae and Freddie Mac guidelines. Yes. If Acme Bank meets Fannie Mae and Freddie Mac guidelines, its loans are conforming and are easier to sell on the secondary market. All right. Whoa. Is this too long? What's going on with this? Maybe it's too long. Why is it giving me a hard time? Okay, let me try this. There must be a limit to chat. There we go. Yeah, there's a character limit to chat, obviously. Mick forces Mick focuses on originating mortgage loans. He works at a company that has in-house loan processors and underwriters. The options he offers consumers are limited to the products offered by his company. What's Mick's position? Is he A real estate investor, B, a mortgage broker, C, a mortgage, I'm sorry, B is mortgage banker, C, mortgage servicer, or D, mortgage broker? The trick is the hint is the options he offers are limited to the products offered by his company. Paul says B, a mortgage banker. That's what I believe it to be. Yes, mortgage bankers actually do the lending. They have in-house loan processors and writers to lend the limit. And of course, we know a mortgage broker is a third party company. Okay. What could be a consequence if there was no secondary mortgage market? A, interest rates would fall. B, there wouldn't be any institutions available to service loans. C, unemployment would increase. Or D, lenders might not have enough funds available to make new loans to the public. D, I believe that's my answer too. Purchases made on the secondary market provide primary lenders with funds to continue making loans. Without this market, lending funds might become scarce. Good job. The purpose of the Truth in Lending Act, or TILA, is to A, require lenders to treat all applicants fairly, regardless of their religion, race, color, national origin, age, disability, or familial status. B, require lenders to make disclosures that allow consumers to compare the costs of making a purchase using credit from different lenders and to compare those with the cost of using cash. C, require lenders to publicly disclose all data regarding credit applicants and the disposition of mortgage loan applications. Or D, require lenders to treat others as they would treat themselves. This is a hard one. Um, the purpose the purpose of the Truth in Lending Act. I think I know, but I'm going to let Paul give me his. Oh, I think you might be wrong on that one. Yes, you are. I'm gonna go with B. Require lenders to make disclosures that allow consumers to compare the cost of making purchasing using credit from different lenders. Okay, yeah, the Truth in Lending Act has nothing to do with fairness to race or religion or anything like that. And that was those were the two that I was going back and forth, but yeah, B. When Stacy's clients ask her if she can recommend a mortgage broker, she promptly gives the name of the best mortgage broker she knows, Gary Jones. Later, she always receives a check from Gary as payment for the referral. This would this be legal or illegal under the Real Estate Settlement Procedures Act, or RESPA? Let me put the question in there. Okay. A, this is legal under RESPA because the referral fee didn't involve granting credit. B, this is legal under RESPA because Stacy has proven experience with the mortgage broker she referred, so it's an honest transaction. C, this is illegal under RESPA because it's considered a kickback between settlement service providers. Or D, this is legal under RESPA because it's considered a partnership. Paul says C,
But it could be D.
it's C. You know it. RESPA prohibits licensees from providing or receiving referral fees or kickbacks to and from settlement service providers, which means this is illegal under RESPA. Also, Stacy may suggest a few mortgage brokers, but the final decision is up to her clients. All right. Lawrence is a buyer closing on a home for which he's obtaining financing. Which document will give Lawrence an estimate of the costs he'll likely pay at closing? That question in there. Okay. A, closing disclosure, B, mortgage disclosure, C, buyer worksheet, or D, loan estimate. I'm going to read that one again. He's a buyer closing on a home for which he's obtaining financing. Which document will give Lawrence an estimate of the cost he'll likely pay at closing? Oh, I think I know. Yeah, I'm going to guess. We're going to see what Paul has to say. Paul is saying D, the loan estimate. Let's see if Paul is right. The
So
loan estimate, yes, required. See, I was going with A. I always get the loan estimate and the closing disclosure. So the loan estimate comes. All right, the loan estimate required by the Dodd-Frank Act informs buyers of the cost they're likely to pay at settlement and discloses the mortgage loan specifics such as key features, costs, and risks. I want to put the wrong answer in here for just a minute. Um, yeah, let me go back. Let's put closing disclosure, see what it says. The Dodd-Frank Act requires that certain information be provided to borrowers during the lending process at least 3 days before closing. Lenders provide the closing disclosure, okay, which details borrower's final, not estimated closing costs. So option A is incorrect. There's no official document titled mortgage disclosure or buyer worksheet. So option B and C are out. The loan estimate provided to borrowers within 3 days of loan application is an estimate of the buyer's closing costs, making D the correct answer. The loan estimate provided to borrowers within 3 days of loan application. Okay. Okay. I just wanted to make sure that I understood it. All right, next one. Gregory and Diane are American citizens of Cuban origin, and when they're denied a home loan, they suspect discrimination. Which of the following acts prohibits lender discrimination on the basis of protected class of national origin? This is the one where I always kind of fail because there's so many different acts. A, Equal Credit Opportunity Act, B, Community Reinvestment Act, C, Consumer Credit Protection Act, or D, Mortgage Home Discrimination Act. Hmm. A, B, C, or D? Equal Credit Opportunity Act, Community Reinvestment Act, Consumer Credit Protection Act, or Home Mortgage Discrimination Act. Paul is going to say A. That's the one I was going to go with. Let's see. Yes, the Equal Credit Opportunity Act prohibits lender discrimination on the basis of an applicant's protected class status such as national origin. Good job. What factors does the underwriter consider in reviewing a mortgage loan application? This is one that I always have trouble with. I remember this one a little too well. Um, what factors does the underwriter consider in reviewing a mortgage loan application? A, credit, capacity, and collections. B, capacity, collateral, and criminal record. C, credit, credentials, and collateral. Or D, credit, capacity, and collateral. Paul's saying D. Yes, underwriters review the borrower's credit score and history, capacity to pay the loan, and the collateral, which of course is the house or property. Let's do another one. All right, we should be finishing this one relatively soon. Financing. Oh, we're done. We finished that one. You want to keep going or you want to stop? This is two of two, two of two, two. You know what? Let's go do the exam. Let me go back. So we did a couple of these. Let's see how many did we do here. We did contracts and financing, but I didn't do the exams. Let's go do the exams. So the exams we won't have the answers right away, but until the end. I got 100% on this one the last time I did it. All right, let's retake, and it's going to be 10 questions. Which one of the following options best describes the purpose of a sales contract? Now this, you could just put A, B, C, or D, but obviously A, B, C, or D isn't on there. A, it identifies the buyer's agency relationship terms. This is a sales contract. B, it identifies the landlord-tenant relationship terms. C, it identifies the listing agent buyer agency relationships term. Or D, it identifies the terms of a real estate sale between the seller and the buyer. There's really only one that really makes sense, doesn't it? What do you think?
Well, there's no A, B, C, or D.
I know, it's well, A, B, C, or D.
I would go with D.
D, it identifies the terms of a real estate sale between the seller and the buyer. Okay? We won't know until the end here. What phrase do many real estate contracts contain that reminds the parties to avoid unnecessary delays to the transactions and adhere to all contract dates? So we'll say A, haste makes waste. B, patience is a virtue. C, seek the advice of an attorney. Or D, time is of the essence.
Times of the essence.
Time is of the essence. Yes. Oh, wait, we don't know yet. Jane was tired of waiting for her subcontractor to get his part of the deal done. The agreed upon deadline came and went, and Jane lost money waiting for the subcontractor to come through. She decided that if the subcontractor wasn't going to honor his commitments, neither was she. So Jane consulted with her attorney and then terminated the contract. This is an example of A, accepting partial performance, B, mutually rescinding the contract, D, oh, C, I'm sorry, that was B, C, rescinding the contract unilaterally, or D, suing for damages. Well,
Unilateral.
it's not accepting partial performance. She didn't sue for damages. I don't think they really mutually rescinded the contract, so rescinding the contract unilaterally is my answer. Wouldn't you agree?
Yeah.
All right, let's go forward. Your 15-year-old son just signed a contract joining a health club, which costs $50 a month. Which of the following best describes this contract? A, the contract is missing a legal object. B, the contract is missing offer and acceptance. C, the contract is void. Or D, the contract is voidable.
Voidable.
Voidable. That's right. What happens to an initial offer when the buyer what happens to an initial offer from the buyer after a seller counters? A, it becomes the backup. B, it's accepted by the seller until the buyer accepts the counter. C, it's no longer in play. Or D, sellers cannot counter a buyer's initial offer.
No longer.
Yeah, no longer in play. If a buyer includes a clause in the offer that reads, buyer to beat all competing offers by $1,000 up to a price of $700,000, the offer is considered what type of offer? A, dynamic, B, elevator, C, escalator, or D, flexible.
Dynamic. Escalator.
Is it escalator or elevator?
It's escalator.
Escalator. See, I would have got that confused.
You just picked elevator. It's escalator.
I said escalator. Oh, you've got a delay. You don't see that yet. I clicked escalator.
Okay.
Oh, there is quite the delay, isn't there?
Well, I took that off. I couldn't.
Okay. Let me let it catch up for you. Okay. Jerry and Simon signed a contract giving Jerry the option to purchase all of Simon's restaurant equipment for a set price after Simon closes his restaurant next month. The contract contains a provision that states Jerry has 1 year from the purchase date to file a suit relative to the purchase. After the year is up, Jerry forfeits the right. What kind of contract clause is this? A. Specific time. B. Statute of limitations. C. Time is of the essence. Or D. Time of performance. All right, let's read that again. Jerry and Simon signed a contract giving Jerry the option to purchase all of Simon's restaurant equipment for a set price after Simon closes his restaurant next month. The contract contains a provision that states that Jerry has 1 year from the purchase date to file a suit relative to the purchase. After the year is up, Jerry forfeits the right. What kind of contract clause is this? I believe that to be a statute of
That's
limitations.
what I would pick.
Yeah. All right. When Dashiell received the purchase offer on his bungalow, he was surprised to see a page added to the contract requesting that an attorney review the contract. What is Dashiell looking at? Is he looking at A. Addendum, B. Amendment, C. Annotation, or D. Appendix? I know it's not an amendment. I know it's not an appendix. Is it annotation or addendum?
When wait, received a purchase offer.
No. Amendment or addendum? It's not is
Amendment.
amendment amends a contract. Oh, all right. You want to say amendment? I
It's
think
not a
it's,
separate sheet of paper.
isn't it? You're surprised to see a page added to the contract requesting that an attorney
The
review.
addendum is just a cross off and rewrite.
All right. You want to say amendment? All right.
I'm going with amendment.
Okay. We'll go with amendment. See who's right at the end. Eleanor is moving from a starter home. Now I got this 100% last time. If you messed me up. Okay. Eleanor
I
is
might be getting it mixed up.
yeah, I don't know. Eleanor is moving from a starter home into something a little larger. Her agent has cautioned her against making the offer on the new place contingent on the sale of Eleanor's starter home. Why the caution? A. Eleanor might want to keep and rent out her smaller home as an income source. B. Eleanor should include a minimum of two contingencies to let the seller know she is serious. C. Eleanor's lender might be wary of contingencies. Or D. Sellers would view an offer with that contingency as a stronger offer. Oh, without that contingency as a stronger offer. That's what I think. Is moving out of a starter home. Yeah.
Why the caution?
Sellers would view the offer without that contingency.
Bottom one,
It's
yeah.
the bottom one. Yeah. All right. Last question, and we'll see who's right and who's wrong here. Grace found herself in a breach of contract situation where the other party met some of the terms but not others. Grace thought it would cost a lot of time and money to sue, so she decided to accept the work that had been done and call it good. This is an example of A.
Accepting partial performance.
Accepting partial performance, B. Mutually rescinding, C. Rescinding the contract unilaterally, or D. Suing for damages. We both accept that is accepting partial performance. All right, we got 90%, which means we got one wrong. And I know which one. It was an addendum, Paul.
It was?
It was an addendum. Yeah. That's not I mean it's not amending the contract, it's just saying that they want the attorney to review the contract. So they didn't amend the contract. An addendum is like a note to or an addition to or whatever.
So what's an amendment then?
Oh, let's spell amendment right, did I? Doesn't want to do it. There we go. Get it into view here. An amendment is a formal change or addition made to a document, law, contract, or constitution. Addendum is an additional document that is added to a contract or agreement. It is a supplement to the main document. So that's the addendum.
Addendum is an additional document that's added to a contract. Right.
Yeah, addendum is, I just took it away. Oops, I did not mean to do that. I don't want to take that review, that one over again. Did you get it?
Additional an addendum, additional information without altering. Amendment introduce major changes to the original. An addendum.
An addendum is an additional document that is added to a contract or agreement. It is a supplement
Amendment.
to the main document.
Fine, we'll figure it out. We don't.
Unlike an amendment, an addendum does not modify the existing content of the original document. Instead, it adds new information or terms without changing what is already established. Oh, good. Okay. Let's go back and let's just do the test for that second section we did, and then we'll call it a day for now.
Yeah.
But we did contracts, we did financing, we did all the study stuff for contracts, we did financing. So let's go in. Oh, you changed my score. Okay, let's see if we can get 100 on this one. So I got 90 last time. So I got one wrong under what? Financing and lending. Okay, this is 10 questions as well. All right. Jerome is developing an ad for 3 properties he has listed in an upscale community. He wants to keep it short and simple. Which of these would not trigger full disclosure under TILA, Truth in Lending Act? 10% down payment, 30-year fixed rate with no points, a monthly payment of $900, or get a low 4.925% APR.
Either developing an ad for 3 properties.
Yes, get a 4.925%. Okay. Lucy's client, Caden, wants to purchase a new construction property, and he wants to get as much house as he can afford. Which of the following does Lucy need to advise Caden about regarding interest rates when purchasing a newly built home? Which of the following does Lucy need to advise Caden about regarding interest rates when purchasing a newly built home? If Caden uses his builder's lender, he can get a better interest rate and won't have to worry about market fluctuations between now and closing. Caden doesn't need to worry about interest rates for his long-term mortgage until 90 days prior to closing, when he can lock in the best rate. C. Caden needs to allow for the possibility of an interest rate increase between now and closing because lenders aren't likely to lock in an interest rate for more than 90 days before closing. Or C. Caden needs to lock in the interest rate on his long-term mortgage now to avoid unexpected increases that could put his loan amount over his approval amount.
3.
Yeah, yeah, I think you're right too. All right. Recently retired Admiral Bongo and his wife Lucy contact you. They want you to help them purchase their dream house now that he's retired, but one that has the necessary accommodations for the Admiral's disability. They also confide in you that they don't have a lot of money saved up for down payment. Which type of financing may work best for them? A.
A.
a VA loan, which requires no down payment. Yeah, we'll go for that one, huh? Shirley's lender discharged the mortgage lien on Shirley's property after processing her final payment. Which clause requires the lender to take this action? A. Acceleration. B. Alienation. D. Defeasance. Or D. Due on sale.
Number two.
Alienation?
I don't know. That's why that's.
Defeasance.
Is it defeasance?
Well, it's not acceleration because an
No,
acceleration
it's not
clause.
acceleration. It's not due on sale.
So it's either alienation or defeasance. I think it's defeasance. I could be wrong. I'm going to say defeasance, but you remember you said alienation. We'll find out. What does PITI stand for? Price, information, trust, interest. Price, interest, taxes, insurance. Principal, interest, taxes, insurance.
Three.
Three, yeah, principal, interest, taxes, and insurance. Traditionally, lenders qualifying mortgage rules use a range of percentages to qualify for both the housing debt to income ratio and the total debt to income ratio. What are those ratio ranges? 25 to 28 for housing and 33 to 36% for debt. 25 to 28 for total debt, 33 to 36 for housing. 25 to 33 for housing, 28 to 36 for total debt, 25 to 33 for total debt, 28 to 36 for housing. So I know it's 25 to 28 for housing. I'm pretty sure it's 33 to 36 for debt, right?
Wait. 25 to 28 for housing and 33 to 36 for total debt. Number one.
Yep,
That's what I would pick.
that's what I believe it to be. An agent's client requested a recommendation for a mortgage broker. The agent gave the name of the best mortgage broker. Later, the agent received a referral check from the mortgage broker. Is this legal or illegal? It's illegal. Because the broker has proven it. No, it's legal because it's considered. It's kickback. Considered kickback.
Kickback.
Yeah. What factors directly affect an adjustable rate mortgage? Amortization tables, index and rate, index, tax basis and margin, rate, index and margin, rate, loan to value ratio, and index. I believe it's rate, index, and margin, isn't it?
Hold on. Factors directly adjustable rate mortgage.
Or is it rate, loan to value ratio? No, it's rate, index, and margin, I think. Wouldn't be taxes. The amortization table, no.
I
Loan to
don't
value.
know.
I think it's rate, index, and margin. That's what I'm going to answer.
That's fine.
The blank can.
Seems right. That one or the first one. So
Yeah, I'm going to stick with my answer.
that's fine.
We'll figure it out. The blank can offer direct loans to farmers and ranchers. The loans are funded by congressional appropriation. It's either American Agricultural Lending Service, Farm Credit System, USDA Farm Service Agency, or USDA Rural Development Program. I believe it's the USDA Farm Service Agency, isn't it? Or do
This
you
is
have a
going to
different
be where
answer?
it's direct, right?
I
Loans
feel
are
like it's
funded
the
by congressional appropriations. It's not the rural, it's farm. Go with farm.
Farm Service Agency.
Yeah, go with farm.
Okay. Last question. A buyer anticipates a house payment of 1,000 per month with monthly homeowner association fees of 150. The buyer also has a car payment of 400 per month. If the buyer earns a monthly gross income of 5,000, what is the total debt ratio? So we're at 1550 divided by 5,000.
31%.
31%?
Yep.
That's 1550 divided by 5?
Yep.
Okay, let's see. How many we got wrong? Zero wrong. Woohoo!
That means I got that one wrong.
Which one was that? The
5.
the rate index margin one? No,
No, go up. Number 5.
number 5. Uh,
What's number 5? Question 5.
no, you got that right. Principal, interest, taxes. You got that right. Defeasance.
Not
This one, question 4.
four.
You said alienation. I said defeasance.
Yeah, I didn't know the other one.
Yeah, it's defeasance. Yeah. Well, I got all right that time, so we improved my score. Cool. Alrighty.
Defeasance.
I'm gonna defeasance.
And what was the question?
Let me go back to it. Shirley's lender discharged the mortgage lien on Shirley's property after processing her final payment. Which clause requires
Oh,
the lender to take
okay.
this
Got it.
actions?
Yep. Nope. All right.
Got it?
Yep.
Alrighty. Thanks for nobody watching. Well, maybe somebody might have watched it. They just didn't sign in. Sometimes that happens.